Every model has its advantages and disadvantages. But although you might be scaling, it's really about what you keep at the end of the day.
From what I've seen in the business world, there's nothing like it. Like the ability to buy a building, sign a lease, and create hundreds of thousands of dollars just off that alone. It's crazy.
The first thing is to kind of learn or think about where you want to be in life, and then, okay, how am I going to get there? And then ride the waves of opportunity.
What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint Podcast. I'm excited for today's guest. We have Adam the Brit here. He is a commercial real estate investor and also an upcoming author. He's got a book coming out soon. So we're extremely excited to have you on the show and kind of dive into your story and what you got going on. So we appreciate you coming on, Adam.
Great to be here, Graham. Thank you so much. Yeah, it's definitely been a journey, but I'm excited to talk about it.
Yeah, absolutely. I was telling you, just before we started recording that I went to an event last year in Orlando where you got on stage and you were talking about some of the projects you were working on, and it was just mind-blowing. That event really opened my eyes to what's possible in commercial real estate. But I know you mentioned you have right now 1.5 million square feet of commercial real estate, which is wild, and we'll get into that. But yeah, for the people who don't know you, give us kind of the backstory of who you are and what you do.
All right. Well, I'm Adam the Brit, originally from the UK, obviously, I guess. Accent's a giveaway, right? And my my real estate journey started with some office warehouse buildings in the Netherlands, which was where I was living for the time. And it was kind of by accident, really. I never really liked the idea of renting anywhere. And I had a business that needed some space, and it outgrew the second bedroom, or the only other bedroom I had free. And I was like, it's time to buy something. And back in those days, it was actually possible to get 100% financing from the bank. And I guess I didn't realize what a blessing that was back then. I thought it was normal. You don't know what you don't know. And so I bought this industrial building, and then I bought the one behind it for potential expansion, and decided to rent it out in the interim. And little did I know that I rented it to a hydroponic grow facility in the marijuana space. And a number of months later, I kind of rolled up, and it was full of the equivalent of the Dutch SWAT raiding the place, and it was all getting carted out. And needless to say, I lost my tenant. So that was kind of the first exposure to commercial real estate. And in 2001, I moved to the United States to set up the US branch of that business that I had already expanded out to the Far East, and obviously started it in Europe. And I was in the lucky position. It was basically a semiconductor brokerage. So I was buying and selling semiconductor chips. It was around the sort of year 2000 turn. The internet was exploding, and it was a great time to be in that space. But I kind of realized that it had a limited timeline. Like anything, opportunities are, you have to grab them when you can, because not everything stays the same forever. And there's kind of a turning point. And I knew as a broker, I was the middleman. And what gave me strength was being able to find these components that were hard to get quickly and easily. But with the internet, everything became very transparent. And so it effectively killed the business. So what I decided to do, instead of investing money in that business that I knew ultimately was going to die, I decided to start buying apartment buildings. So I bought my first apartment building in Houston, Texas. It was a 16-plex. I had just moved to this country. I think I'd been here 3 months. I didn't have a social security number. I didn't have a job. I didn't have anything. And luckily, I was introduced to a local bank, Houston. And based on my balance sheet, they were able to give me a loan to buy this first 16-unit building. So over the course of a few years, I bought a 16-plex, I think a 10-plex, a 28-plex, lots of small buildings, but all within a similar geographical area. So it was a management headache, but it wasn't as bad as it kind of sounds. And so that was kind of, I guess, the start of the commercial real estate journey. So that's kind of, I guess, where it started. And then I'll keep going if you like.
No, it's okay.
It's a long story. And I think I was up to about 150 units, and we had a manager and a couple of maintenance guys, and actually went to Australia for a little while, maybe 5 or 6 weeks. And about halfway through that trip, I was unable to get hold of the property manager, and then we noticed money was missing from various bank accounts. And to cut a long story short, it turned out that the property manager had been playing a bunch of tricks with regards to occupancy and stuff, and been stealing a lot of money. And she ended up spending 18 months in the state penitentiary for that. So that was kind of my initial American, the American dream: come to this country and then get ripped off by your property manager. So that was kind of my initial exposure to I guess residential or multi-tenant, residential real estate.
Yeah, that's super interesting. I kind of thought of two questions I was going to ask. One, you kind of indicated this, but you said you came here and you didn't have a social security number or anything like that. So obviously lending back then was a lot different, but you were able to just jump right into a 16 unit. And I imagine that's because you had that income and you had some cash probably saved up from the successful business you were running.
Correct. So, I mean, I think the lesson is definitely, if you want to get into, investing in real estate, particularly, you need to be creditworthy from a bank. Obviously with a commercial property, the lender is looking at the income from the property primarily. That's a sort of primary driver. But, after that, they're looking at, your credit score, your ability to repay the loan should the property have a problem. Obviously, if you're in the sort of residential space, flipping houses or whatever, that's very applicable because there's no residual income from those houses. It's just a buy, sell, flip. And so there's no income. So, I definitely do talk to a lot of people that really want to get into either commercial or residential investing, and they're going to go all in and give up their job and everything else. And I'm always like, guys, you need to keep the job going as long as you can to stay creditworthy for a bank, and you should only really give up your job when you've had a few years of experience, you've got cash flow predictability. The banks like nothing more than predictable income streams when they're underwriting you. I think that was something that I kind of learned early on, that having other income sources is very important, especially when you're starting out.
Yeah.
Pre-2008 and all that stuff, how much did they look at the property itself, or were they really just kind of concerned about you? Like, it sounds like they didn't even have any concerns about like any kind of like citizenship or anything like that either, which is kind of interesting.
Yeah. So I was, I obviously was here legally I came in on an E2 visa, which was an investor visa. And I had initially an ITIN number, which is a number that foreign nationals get for, in place of a social security number. And, I think pre-financial crisis there, historically banks, a banking relationship was worth something. Banks had a lot of discretion, to lend to known customers, or, the relationship was super important. It's still important today, but, the banks are a lot more regulated now than they were, 20 plus years ago. So I would say was probably easier then to get a loan, based on relationships, based maybe on deposit balances, that kind of thing. Today I think it's probably a lot harder if you're starting out, and you don't have a social security number and obviously any history, but it's not impossible. I think everything's possible if you put your sort of effort to it.
Yeah, no, absolutely. The second question I had, going back to the story, is how did you recover from something like that? Like, that seems like they had potential to end your commercial real estate investing journey, or just end you financially. So I'm curious, what did you do to make up for everything that happened, all the money they stole?
Well, they kind of they say what doesn't kill you makes you stronger. So I mean, I think life is a series of setbacks, and it's what you take away from that. It's I think Tony Robbins says it doesn't happen to you, it happens for you. And so my mindset was that was, I guess, the wake up call that this was going to be difficult to scale. And as I was still I still had other business activity. I wasn't in real estate full time. So I needed something that I, wasn't super hands on. And I kind of realized that, it probably was not the right way to go. And that's really when I sort of started looking at, what else could I do in the real estate space that would allow me to scale and still do other things, but also have more predictability of cash flow. One of the big issues with residential real estate, it's the old joke, tenants and toilets, but there's just a whole slew of things that you as the landlord are responsible for, from the toilet, fixing the toilet, to cleaning the bed bugs out, to pretty much everything, paying the taxes and insurance and all the expenses. It's you're very exposed as a landlord to a lot of things that you can't necessarily control, like taxes and insurance. And we've seen in the last sort of 6 months, or I guess the last couple of years really, insurance prices skyrocketing, and the cost of maintenance and repairs, and even people skyrocketing. And in the apartment space, you can't really pass those expenses on, and especially in markets that have some type of rent control, you're typically not allowed to raise rents by more than CPI, or maybe CPI plus 4 or 5%. So those 6 to 10% bumps that you might be able to do if you're lucky are not necessarily covering the increased costs. So I kind of realized that I didn't necessarily want that type of exposure, especially if I had a larger portfolio. And so I decided that I would look for real estate that was triple net leased. And, that basically means that the tenants are taken care of, or basically paying, this is a generalization, but they're basically paying for everything, even including the property management. And so as a landlord, your sort of P&L is a lot more, and your cash flow is a lot more predictable. And really that's, I'm a cash flow investor. I like to buy cash flow. I like the predictability of it. And I found that wasn't possible through multifamily. Having said that, obviously I have, a lot of friends that, some of them have 10,000 units, and it is certainly scalable, maybe at a higher type of, a better quality asset. I was really doing sort of C-class apartments. And I think if you kind of go into the A minus, B minus maybe products, you can probably do better because the tenants are slightly more dependable. Let's put it that way.
Yeah. I think it's interesting that your first commercial real estate deal was really owner user, and it was a office kind of like warehouse kind of building, correct?
Yeah. So basically it was in an industrial business park, and it was a small bay, effectively a small bay warehouse. So I had, it's probably, 3,000 feet. And it was probably 1,500 square foot of warehouse and 1,500 square foot of office. And then I bought a building directly behind that. They weren't actually physically touching. In my sort of non-knowledgeable mind, I was like, well, I could always put like a sky bridge between the two. It would be kind of cool. But that never happened because I never actually outgrew that space in the Netherlands.
Gotcha. Yeah. So you went from small bay to multifamily in Houston. When you came to the U.S. and you wanted to, you were talking about buying real estate, and you jumped into multifamily. Why did you choose multifamily after experiencing a little bit of small bay? Just curious.
That's a great question. I don't remember. It was a while back. And, probably because I guess when I bought when I bought the buildings in Holland, I guess I didn't really sit and think about it. I just bought them, and I was making reasonable money at the business I had. And, my main thought there was, I'll just have a tenant to pay off the mortgage, and in, 25 years, I'll own it. I wasn't really thinking about the cash flow side of things, or, really what I was doing. I mean, I was a 20-something-year-old, kid, and I guess I hadn't really kind of formulated the real plan. It was obviously for an owner user initially, and that was to save on the rent and pay off a mortgage as opposed to paying somebody else's mortgage. But good question. I've never really thought that. I don't know. I don't know why. It probably just because I don't know. I really don't know. Maybe it was because when I actually came to Houston, I was I was new. I didn't know anybody, and I joined a real estate investment club. And so that used to meet once a month. I think it's still in existence, called the Rich Club of Houston, Real Estate Investment Club of Houston. And it was a nonprofit. And a lot of the people that were there, or actually most, if not all of the people that were there, were either house flippers or in the apartment space. So I probably kind of, you are the sum total of the 5 people you spend the most time with, right? So I was probably spending a lot of time with those kind of people. And so that probably kind of gave me the the idea to do that initially.
Yeah, that's awesome. So we see that seems to be a trend with a lot of people, real estate investors in general. Like you said, you didn't really start in residential, like houses and stuff, but a lot of people will start in houses and then they'll move up to multifamily. Mm-hmm. And then once they get to multifamily, they kind of have the same realization that you have. It is kind of harder to scale. It's definitely more management intensive. And, most importantly, the responsibilities are passed to the landlord for the most part. So then they want to graduate into commercial, which, multifamily over 5 units is still commercial, but more traditional commercial real estate like industrial, retail, whatever it may be. So I've seen that. That seems to be like a trend for sure. But I'm curious, you mentioned you have 1.5 million square feet right now. I'd imagine a lot of it's, or none of it's multifamily. So walk us through your portfolio today. Where's everything located? What areas of the country? And then, what kind of asset classes do you guys have?
Okay. So basically it's kind of roughly split into two asset types. I'm a big believer in not being dependent on any one tenant. So I'm really focused more on multi-tenant buildings. And so I own a number of multi-tenant retail centers. The majority of them are focused on an Hispanic demographic. And I chose that demographic for a number of reasons. It's the fastest growing demographic in this country. And due to, and this is a lot, obviously some generalization here, but due to the sort of inherent mistrust of banks or potentially legal status, a lot of Hispanics aren't very well banked, which means that they don't have access to credit cards, which means that it's very hard to buy online in places like Amazon. Secondly, a lot of the apartment buildings that the Hispanic population live in typically don't have Amazon lockers or places to have stuff delivered. And so it's very hard to buy online due to theft. In an earlier life, before I started the semiconductor business, I used to work on street markets, and I started in Australia, in Sydney, and then moved to the Netherlands and was working on the Amsterdam street markets and, basically, selling whatever I could find that was cheap. And I grew it to a fairly significant business with a number of people working for me and a wholesale business and also some retail as well that we were renting shop space. But what I realized was that, the client base there was all immigrants. And, there's just immigrants typically like to touch and feel and smell the products, and you can't do that online. So I decided to buy or focus on infill Hispanic sort of demographic retail centers with like a Hispanic grocer or a discounter like a TJ Maxx or a Ross or something as an anchor, and then some smaller shops that support the local kind of community needs. Think anything from a nail salon to a doctor's office, a dentist, furniture rental, you name it. So lots of small businesses. I like to try and focus on a shopping center that has no one tenant has more than 20% of the income stream. And that way, you have that diversified rent roll, protects you against risk, and you're not so beholden to any one tenant. And I also only focus in areas that are infill. So, today it costs, depending on the market, but let's say a couple of $100,000 or a couple of $200 a foot to build a shopping center. And often the rents that you get in those type of locations don't justify any new construction. So what there is what there is. Typically, there's no available dirt in these areas because they're established neighborhoods. And so you're protected from, competition coming in and undercutting you because your basis is always going to be lower when you're, operating older buildings. So that's kind of the retail piece of it. And then
real quick question before you move on. I've heard people, use the term infill for like residential lots and stuff. Like if it's a neighborhood, there's a lot that never was built on. So somebody buys it and does an infill house. But can you elaborate a little more on what you mean by infill retail centers? Like, I guess in terms of, the infill part.
So, basically it's the same theory, right? It's, if you buy a lot in an established neighborhood, how residential neighborhood we're talking about now, or a house, an old house in an established neighborhood, typically if it's the right kind of neighborhood, over a certain period of time, those houses will be refreshed. So the original houses would be torn down and new houses would come along. And, there's just no available dirt. So if you want to build something, you have to buy something that's existing, scrape it, and then rebuild it, right? And that's always a lot more expensive than if you go buy a house or a lot in an area that is that has a lot of available dirt still, or a lot of land, and obviously in an area that has a lot of land, the land price is going to be cheaper, so land plays a less important role in the overall construction cost. And with commercial real estate, it's kind of the same thing. You can choose to buy a shopping center in a developing neighborhood, and in Texas, obviously there are a lot of those growth areas where a big tract home builder comes in and puts thousands of homes down, and these areas evolve very quickly, but typically there are still going to be a lot of pockets of dirt available, and you could put your shopping center there for whatever a price, but you just don't know what's going to come in all the vacant blocks that are around there. So it's a more risky proposition. Obviously over time it will fill out, and and then you kind of know. But I like to kind of take out the variables and try and reduce the risk as much as possible. And for me, buying in an area where that no one's going to come and build something better and next door to you is always advantageous.
That makes sense. Okay, yeah, that's awesome. So you were going on to the next portion, which I am gonna guess is industrial, like you mentioned.
Yep. So industrial kind of came about. So just before the financial crisis, I had actually looked at some dirt to develop a sort of a condo small bay industrial deal, and then the crisis hit. So that plan kind of got stalled. But it was always in the back of my mind as a way to diversify some risk outside of retail. And it was really during COVID that the plan came to fruition. Obviously, when COVID hit, I was very nervous with regards to whether we were going to be able to pay the mortgages and tenants were going to survive. And we were lucky that really only had one credit tenant, in fact, file for BK, and everybody else made it through. But even so, I realized that it's never good to have all your eggs in one basket, so to speak. And I decided that I needed to really start looking at commercial real estate, industrial real estate. But, to the same point, I didn't want to do single tenant industrial because you're kind of, it's either a hero or zero, right? It's kind of like you're either 100% leased or 100% vacant. And I don't like that variable. So I started looking more at the small bay space, talking, units of maybe, on the smaller side, 1,000 square foot up to maybe 3 or 4 on the larger side. And, you kind of had a lot of the same benefits that you would find in a apartment building, whereby the leases are typically short term, 1 to 3 years. You have, one building with maybe 60, 70, 80 tenants. But the advantage of that product over apartment buildings is they're a triple net leased. So, the tenant is responsible for their AC when it breaks, the toilet when it blocks up, the light bulb when it goes out, et cetera, et cetera. And with a small bay building, a small bay industrial, there's not really any tenant improvement that you need to provide. It's a very simple building. You've maybe got a couple hundred square foot office and then a warehouse, and there's no carpet, there's nothing fancy in there. So when they turn, they're very, very cheap. You don't have to do a lot of make ready expense, and there's no tenant improvements offered, which typically you will have when you have a retail tenant come along. So from a landlord perspective, it's an interesting business. It's obviously more management intensive than a single tenant building. But so that was kind of the thing that drew me to it. The other thing was that because the leases are short in nature, usually 1 to 3 years, you're able to adjust to market forces a lot faster than you would be in maybe a retail lease that's 10 years long. And you can also kind of adjust for inflation a lot better. So it's a lot more inflation proof than a retail building, in my experience.
Yeah, that's a good point. I hadn't thought about that. So did you see, they're signing 1 to 3 year leases. Did you see a lot of in and out movement with those small bay garages? Or are they staying they're just signing 3 year leases, but they're actually staying? I'm just curious.
So Typically we like to do a 1-year lease because I always say, at the end of the day, most of these tenants are not super credit worthy, and a lease is really, only worth the paper it's written on, right? At the end of the day, and much like with a tenant in an apartment building, it's just not really feasible to go after a tenant for non-payment of rent, and if you're on top of it, you shouldn't have that much of a backlog in rent anyhow. So we really push for 1-year leases, and on occasion we'll do 3 if the tenant seems creditworthy. I would say there's more turn for sure than there is in retail. The thing that people forget, I think, about industrial buildings by and large is it's more of a commodity. Okay, like if you have a retail store, let's say you have a bagel shop, people know where that bagel shop is. It's positioned on their way to work or their way to wherever they go, and they stop off there. It becomes convenient, it becomes habitual, and you can't just go take your bagel shop and move it across the street and expect that all your customers are going to follow, right? Now, with a small bay industrial building, it's typically not so retail focused. Some of them can be, but most of them aren't. So really, if it's, let's say it's a plumbing supply company, whether they're in this building here or the building down the road, their customers never come there. They don't care. And so the tenants are a little bit more fickle and, more susceptible to move down the road if they can save, some money or there's a special or whatever. So, I would say there's definitely more turn, but, like anything, over time, I think you build a base of tenants that are going to stay, and eventually you get a more stable building. But there's a price to pay for every asset class that you choose. That it's not all good.
Right. You got to pick what you want to work with. Me and Graham were kind of talking about that when we were like really trying to find our first deal. We were like, do we want industrial? We want retail? And to your point, no tenant improvement. We don't have tons of money to just shell out for, tenant improvement allowance, whatever. We can just say, hey, this is the building. You like it, you don't. We can give a couple months free rent. That's no money out of our pocket except for, floating the mortgage. And that just worked better for us. So I wanted to highlight that. And I think you're right about the contractor bays. People will, when they have less than 5 to 10,000 square feet, they will move around if they need to, because like you said, plus to give the credit to the businesses as well. Some of them are growing and they need bigger spaces. They might actually outgrow that 3,000 square feet or whatever it is. So those are all good points too.
Yeah. What I also, one thing I have seen and, is that if you're looking at, real estate, commercial real estate as and you're looking to kind of flip it as opposed to kind of keep it and operate it. There is an argument to be had that, small bay industrial is easier to flip due to the fact that it does have shorter leases. If you're in an area where there's demand and you can find a building that, has under market rents, typically you don't have to wait that long to be able to raise the rents, to raise the income, and ultimately to raise the value of the property. So, I would say it's definitely a good vehicle if you're trying to, move from, flipping houses, let's say, to, okay, what would be equivalent type products in commercial real estate. I think, this is definitely, a product that lends itself to kind of turning and burning, as it were, if you're trying to build up some capital to, buy buildings to hold longer term.
Yeah, that makes a lot of sense. Because then I was curious about, since we're talking about these short-term leases on these, I've seen a lot of small bay and they're all condoed out. So, the owner doesn't really own it. The tenant owns their section of it. Why is that a popular thing?
So it's becoming a lot more popular, actually. And I'm, you certainly, I'm on the West Coast here. You see it, a lot more in expensive markets. There is also, actually, there's a company in Texas that just does that. They build sort of man caves. So that's a slightly different business model. But I think really the main reason is that, if it's the right type of building and the right type of market, you can sell a small piece for a lot more than you can sell a big piece, right? So, it's kind of like, the analogy would be you're buying, a wholesale building and then you're selling it retail, you're splitting it up and selling it in smaller pieces. So I think, the main driver is obviously profit, money. The sort of the advantage to the, quote unquote tenant slash buyer is that, if they're putting their business in there, they can get SBA financing on that deal. They can come out of pocket, 10% or less for a down payment. And so, they can, instead of paying rent, they can pay off a building. They also get the tax benefits from that, obviously, as well. So, I think it's kind of a popular thing, but it only works in the right markets. Now, from an ownership standpoint, the disadvantage of doing that is that, if you, let's say you had a 50,000 square foot building and, you had 20 tenants or 20 bays, 2,500 square foot each. And, let's say you sell, 8 or 10 of them or 12 of them, then you kind of have, and, you have a building that you're half pregnant with, you still own 10 units, you've sold 10 units, those 10 units are potentially competing for tenants if the buyer decides they want to rent it out. So you kind of lose control over that immediate market, and it could be detrimental to the remaining products. And also, investors are typically not as keen to buy condoed property, especially if it's, a fractured condo. So, you've got to be pretty confident that you can sell the whole 50,000 feet and all 20 units. Otherwise, you're kind of, quote unquote, left holding the baby. And, we always used to say in the market business, the profit is usually in the last unit or 2 or 3. And so, you could end up doing all that and still, maybe you own those units free and clear, but you may not even put any money in your pocket until you sell them all. So it's certainly a strategy. It's something that I'm looking at right now, but, really needs to be in the right market.
Yeah. I have a question, that I think probably a lot of people would ask when they hear that you have 1.5 million square feet. That just seems like a massive portfolio, because it is a massive portfolio. So just tell us how you did that. Was it just years and years and years of work, or was it one building at a time? Did you have a bunch of different partners? Did you do it by yourself? Like, just kind of walk us through how somebody could go about actually building a portfolio of that size.
Well, I think it kind of came from, a number of things. Being in the space for a long time, I always had other businesses, operating businesses. So for me, the real estate was a dump for the cash that I made. I wasn't really a big, I'm not into the cars and boats and flash. So I just used to put the money back into the real estate. And so it kind of grew, I guess, to a point. And, it's a cyclical market. So, there was, a big opportunity, obviously, during the financial crisis to buy real estate. And then, once that kind of opportunity, expired, as it were, the prices went up. I was in a situation where I was like, okay, let me, think about what I want to do. And do I want to do real estate full time? And so I decided in sort of 2015 to get into real estate full time. And, they always say, your action goes to, where your focus is, right? And so, when it became a full-time focus, I started putting a lot more action together. I think at the same time, I started going to a number of, groups, mixing with other, real estate investors that were doing, projects all over the place. I was very focused in a very small area with my commercial real estate at the time. It also coincided with a move from Texas to California. And I had a fairly significant exit from a portfolio of commercial real estate in Houston, which was slightly more management intensive. And so, I decided to take that capital and really try and kind of grow it. And so, started the process with investing in a couple of buildings by myself, then with, one partner, like 50-50 partners, and then went down the syndication route. And did 5 shopping centers with a syndication model, and then went back to just buying buildings either by myself or just with one partner. So it's kind of been a real mix of all different kinds of things. I mean, every model has its advantages and disadvantages. So you really just have to kind of think about how you want to scale. But for me, I think a sort of a hybrid of really doing it with one or two other people is probably, for me, preferable, because you have less opinions, less people to please, and typically those people are more sophisticated as investors. But certainly syndicating can be a great way to acquire larger properties, and especially in today's market where you need a much larger down payment than you may have done 6, 7, 8 years ago.
Yeah. I think keeping it lean you don't want too many cooks in the kitchen at the end of the day. You just don't want that many opinions. I think that makes a lot of sense. Shoot, I lost my train of thought. With syndication, what did you learn from syndication? Did you learn that using other people's money was better than using your own and it helped you to scale faster? That's kind of like what I see from like the outside, but I was just curious what you saw from syndication.
Yeah, I think for me, I think the biggest reason let's talk about why I didn't syndicate until, I've been doing this for a long time, and I didn't syndicate for 20 plus years before I started syndicating. For me, the advantage is that it allows you to buy bigger buildings. You share the cost amongst more people, so it gives people the access to invest couple $100,000 in a $20 million building, which obviously you couldn't buy with a couple $100,000. So you get bigger, better assets. The flip side of that is, it's not an exact science. There are always gotchas and surprises in anything. There's no guarantees, and you're playing with somebody else's money, and that weighs very heavy on me, having that responsibility of being a good guardian and of other people's money. And for me, I take that responsibility very, very it really affects me, so I want to make sure I'm doing the right thing. And like I said, because of the fact that things happen, I have decided that I would prefer not to do too much syndication in the future, because I just find that burden, it creates stress for me. It maybe makes you work harder because you've got the responsibility to everybody else's money. But, I feel like, it's definitely a great way to scale. But, if you have nobody else's money and just your own, you get to keep 100% of it. So, although you might be scaling, really at the end of the day, it's really about what you keep at the end of the day. And so I'm kind of, as I age, I'm looking maybe more at the ROE, the return on effort, as opposed to the ROI. And, I think I prefer to scale, if possible, using, my own money, or just maybe one or two, family offices, or as opposed to a lot of individual people, just because, I think that's, that works better for me. But, it's horses for courses. Some people love the syndication model, and that's all they do. Some people will, raise a fund instead. That's another way of doing it. For me, I'm not writing off the, doing syndication in the future if the right deal comes along. But, right now, I think it's hard to do if you want to split it up, because, the margins are not like they used to be. And when you dilute the ownership with a GP interest and prefs, et cetera, it makes it very hard to pencil out in today's world.
Yeah, no, absolutely. And even though Jesse and I are young and just in the beginning, I kind of realized that pretty quickly that, yeah, you can syndicate and you can do all those deals and you can say you have a massive portfolio through syndication and stuff. But at the end of the day, like, how much cash flow are you getting, like you said? Because it's like, what's important to you? It's like, for us, it's, we want to be able to do the things we want to do. Like, for me, I have a young family, so I want to spend a lot of time with them. So I'm trying to build cash flow so that I can spend time with them, hang out with them. Also, obviously, continue to work and do investing and stuff. But if I do a syndication route, it's more like creating a job. And like you said, you're answering to all these different people, and you have that stress of, okay, I have 100 different people's money in this deal, or 20 different people. That, I'm the same way. That would really bug me. I would not be comfortable with that. So I think, there's nothing wrong with, like you said, there's nothing wrong with that. But I remember in that same event when we were in Orlando, Kevin, the guy's name's Kevin, presented on like lifestyle builder versus empire builder. And empire builders, you can syndicate, you can build a massive portfolio, do all these things, build a big team. And there's nothing wrong with it. But then there's the other side where people want to build the lifestyle. They want the cash flow from the real estate to fund whatever they want to do, whether it's travel, spend time with family, or work on other business ventures without that weight of responsibility of a bunch of other people and just creating yourself another like management job almost. So I 100% think, what you say is good, and I agree with it.
Yeah, I mean, I think you have to choose your your vehicle, and it evolves over time, right? I mean, when you're younger, you have a longer runway, so you can you can afford to I guess make some mistakes and fail, and time heals all wounds typically. But when you age, you want to I guess you want to work smarter, and you maybe want to be more selective about what you do. And for me, I think I'm on one side, I'm very ambitious, and I like the idea of having a really large portfolio. But on the other side, I also like the idea of being able to travel a lot and have a nice kind of fairly relaxed lifestyle. And it's just finding that sort of that balance. But I mean, they always say be careful what you ask for, right? But I know people that have gone the syndication route and tried to scale using equity investors, professional money, and you really do end up being a glorified employee, and they always get paid first and the lion's share of everything. And you may end up with a multi-billion-dollar portfolio, but at the end of the day, how much money are you actually really putting in your pocket? And would you be better off or better served just having a lot less and keeping a lot more of it, and not having to answer to these corporate overlords, as it were? And I certainly for me, that's certainly not a model that I would want to pursue.
Yeah.
Well, I think a lot of it is you got to go back to like why you started in the first place. Like, why are we investing in commercial real estate at all? So with that question, what's your why?
For me, I had always, so I guess to answer the question, I have to go back a bit. So it was, I was a high school dropout. I actually got asked to leave high school. And I was living in the UK, and I think in order to the why, you have to decide on where you want to go in life. And so when I was in my very early 20s, I decided that I wanted to live overseas. I wanted to live somewhere warm, and I wanted to have a view of the ocean. So I really like being by the ocean and the water. It calms me. And so, I started looking at, ways to make that happen. And obviously, working at, McDonald's or something like that, which is basically the only kind of, job you're going to get as a high school dropout, wasn't going to cut it. And so it kind of forced me to look at, okay, what can I do to start a business and make money? And so that kind of evolved into, commercial real estate. The reason I was drawn to real estate is it's something that you can do as well as something else, either a job or another business. It obviously has a lot of tax benefits, which, being in California, is important. But, and also you can leverage it, right? You put $1 down and you can maybe borrow, $3, right? So that's hard to do in many industries or many businesses. And so really investing in commercial real estate was, the vehicle that allowed me to ultimately, get me to, that final destination, which is, being in California, living, here, having wonderful weather, Southern California, and having a view, of the ocean from my office. And that, that was really the why, and along the way, obviously it's given me the opportunity to, travel and meet a lot of interesting people and, look at a lot of different businesses. And, it's a fascinating business. It allows you to, achieve, significant net worth if you're good at it. It allows you to impact a lot of people's lives. We build small bay industrial buildings, and we let people rent from us that maybe don't have credit, or it's a new business. We give people a shot, and America's built on small businesses, right? I feel like we typically improve the buildings that we buy. If we buy an existing building, so it improves, the experience of the community. And so I think that, you as a real estate investor, you kind of wear a lot of hats, and it's a really good vehicle to achieve, whatever your why is. I think that really probably is the way, or the reason that it was really appealing to me.
That's awesome. Yeah, that's so cool. There's from what I've seen, I'm still relatively young, but from what I've seen in the business world, there's nothing like it. There's really nothing like it. Like the ability to buy a building, sign a lease, and create hundreds of thousands of dollars just off that alone. It's like, it's crazy. It's crazy. And most people don't know about it. Like 99.9% of people have no idea. Like, because I didn't even know what commercial real estate was, like, back in high school. I wasn't even on the radar, and even in college, I wasn't even thinking about it. But people are driving by it every day, all the stores and shops and industrial buildings, everything. It's wild.
Well, yeah. I think when you think about it, I was having this conversation with somebody yesterday that's looking to get into commercial real estate, funnily enough. And, I'm like, on the drive here, from your house to my house, you passed, probably, 500 commercial building investments from other people. All those buildings are owned by somebody. And, some of them are owned by big corporations or publicly traded REITs. But, the vast majority of, commercial real estate in this country is owned by, people like us, right? It's not big corporations and big conglomerates. It's some guy that's got, a few shopping centers, or some guy that's got, a warehouse building, or maybe two, and they're maybe, accrued it over a number of years, or I don't know, maybe inherited it or whatever. But, it allows you to be, you can grow it to the level that you want, right? You could just have one building and that could provide you a nice retirement income. Maybe you bought it initially for your business and you stop the business, but you keep the building and you rent it to somebody else. It's a nice, a nice income stream. But, on the same side, if you're, young and hungry, you can use it as a vehicle to really scale and achieve great wealth. There's really, the only other sort of business opportunity that, I see that you can do that with is, by buying maybe existing smaller businesses and aggregating them. That's, I guess, the only other kind of relatively, you can use leverage and, so, I mean, there are a couple of ways to achieve similar results, but, only real estate has the tax benefits, which, are super attractive.
Yeah. We interviewed a guy a couple episodes ago who's, relatively famous, I guess, in today's world. I think he is, but, depends on what you consider. He gets almost 1 million podcast episode listens every year, which is wild. But anyways, his whole thing is teaching people how to quit, their jobs with buying commercial real estate and buying small businesses. Those are his two things. So yeah, it lines up exactly with what you're saying. But I want to get into one of the last things we're going to discuss, which is your book. You have a book that you're going to be coming out with soon. So talk to us a little bit about that.
Yeah. So I'm still I'm still undecided on the title. But I really wrote the book actually as sort of, it was cathartic actually just to write it. And it's really my business life story. It starts back in the UK with some realizations that what I was doing was maybe not sort of serving me well. I was in rock and roll. I was a music manager for a couple of rock bands, and we were driving around Europe on tour, and at every single border crossing, we would get strip searched and for drugs and other stuff. This is back in the I guess the 80s. And I kind of realized that, it was kind of interesting, but it wasn't really the lifestyle that I wanted to lead. And so that's kind of when I really, sat and thought about what I wanted to do and where I wanted to end up. As I've already alluded to, I wanted to live overseas. I wanted to have, a house by the water. And I was like, well, how do I get there? And, I think a lot of people start something without really thinking about where they want to go. And, the analogy I use is if you got in the car and, I said, drive to South Carolina at this address, most people would have to put that in their GPS, right? They'd have to sort of put it in the car to give them the direction. And so, the first thing is to kind of, learn or think about, where you want to be in life. And then, okay, how am I going to get there? And, and then ride the waves of opportunity. And, over the, I guess, 40 years that I've been working, there's been a number of opportunities. The internet came online. We had the financial crisis. We had the Y2K crisis. We've had, crypto come, just the explosion of, social media. So these are all opportunities and waves that, have a moment of time that you can really, if you're an early user, as it were, or an early adapter, you can ride those waves and make a lot of money. And so really the book is about my journey of pivoting and arbitraging economic cycles in America, in Europe, in Asia, living on 3 different continents, starting businesses in all of those continents, ranging from selling British telephone boxes to semiconductors to women's clothing, children's clothing, you name it. I've sold it to get to where I am today, right? And a lot of life life can be fearful if you start something new. But, much like anything, the more you try new things and do new things and overcome and succeed or fail, the more it sets you up for the next thing. So it's a book about pivoting. It's a book about designing the life that you want. It's a book about having a direction and becoming the best version of yourself. Ultimately, that's kind of, what it was all about. So I kind of wrote it for really my kids and, grandkids, hopefully one day, and their kids and whatnot, as a kind of a legacy piece. But I think there are a lot of lessons there that, people can learn from. And especially people that may feel that they're disadvantaged. I lived in a number of countries, in Paris for a few years, and in the Netherlands, where I didn't speak the language. I came here as a non-citizen. These are all hurdles that get put up. I didn't have an education, I didn't have a network, blah blah blah, and how to turn those disadvantages into an advantage, right? Because every disadvantage has an advantage to it if you know how to play it. So really that's what it's all about. So I'm hoping it's going to come out at the tail end of this year. As I said, I haven't got a title yet, but I'm working on that, and all will be revealed.
That's awesome. Well, if people want to, connect with you, is there anything about the book yet, or was the best place just to follow you and then find out that way?
Yeah, I think the best advice is to follow me. I'm probably more on LinkedIn than anywhere else. So follow me on LinkedIn. When the book comes out, then I will probably be more active on social. I like to kind of keep a low profile. I'm not really, like I said, I'm not sort of out there with the boats and planes and all that stuff, because it's not me. But, I certainly want to get the message out there. And I do feel that, this is obviously a wonderful country to live in. There's so much opportunity here. And there's obviously a lot of noise right now with everything that's going on. But, there's always opportunity. It's always a good time to start something. There's never a wrong time to do anything. You've just got to be intentional about what you start, and, have, as I said, your sort of the destination in mind. And as long as it's moving you towards that destination, then you're all set, right? You should never start something that's, taking you in a different direction from where you ultimately want to go. So, that's what I'm hoping people get from it.
Awesome. That's awesome. Well, I'm excited for it to come out. I'll definitely be on the lookout. When it comes out, I'll have to get a copy. And if you're listening to this, check out Adam on LinkedIn. It's Adam the Brit, right?
Yep, correct. Adam the Brit. Watch this space. It will be hopefully coming out soon. And hopefully I can come back and we can talk about it sometime.
Absolutely. Yeah, absolutely. Well, thank you so much. This has been super valuable, also very inspiring. So we appreciate your time, and we'll see everybody in the next one.
Yeah, you're welcome. Thanks so much. It was a blast.
Yeah.